I'm Pat Keon, a senior research analyst with Lipper. I'm here to speak to you about fund flows activity for the week ended Wednesday, June 19th. Let's start this week by taking a quick look at the market activity. The equity market indices all recorded gains last week, paced by the NASDAQ Composite, which was up 2.5%, while the Dow Jones Industrial Average and the S&P 500 Index followed suit with increases of 1.9% and 1.6% respectively. All three of these indices captured the lion's share of their gains at the tail end of the fund flows trading week on the strength of a couple of pieces of news. First, there's promising news on the U.S.-China trade war front, as U.S. Trade Rep Robert Lighthizer told Congress that he will be speaking twice with China's chief negotiator in the next couple of weeks, once by phone and once in person. Secondly, there was speculation that the Federal Reserve will be cutting interest rates for the first time since 2008 in the near future. While the Fed kept rates unchanged at its policy meeting this week, it did forecast its intentions for future cuts, as it stated that its goal was to sustain the current economic expansion and that economic uncertainties had increased. These statements led the market to speculate that a 25 basis point rate decrease was likely at the Fed's next policy meeting in July. These statements also pushed government bond yields down further, with the shorter-term maturity bonds, which are impacted more by rate changes, experienced the largest declines. The two-year Treasury note closed Thursday, June 20th at 1.72%, down 14 basis points from its close just 2 days earlier, which was before the Fed's announcement. Let's turn our attention back now to the fund flows activity. We'll start by taking a look at the activity for our fund macro groups. For the week, equity mutual funds suffered net outflows of $2.8 billion. Taxable bond funds took in $4.7 billion in net new money. Muni bond funds grew their coffers by $726 million. This marked the 24th straight weekly increase for this group. And money market funds saw $798 million leave, breaking a streak of 8 straight weekly net inflows. We'll now take a closer look at each one of the fund asset groups, starting with equity mutual funds. This net outflow for the group marked the 18th straight weekly net outflow. The equity mutual fund group started off the year with promise, as it took in almost $20 billion of net new money in January, which marked its best month for net inflows since February of 2014. But 5 straight months of net outflows has left the group with net negative flows of just over $58 billion for the year to date. In a continuation of a long-term trend, domestic equity mutual funds are responsible for the lion's share of this decrease, as they've seen $52 billion leave their coffers for the year. Moving on now, we'll take a look at our equity ETF group. Equity ETFs shed just over $900 million in assets last week. The largest individual net outflows belong to the iShares MSCI EFA ETF and the iShares Core S&P 500 ETF, which saw $2.2 billion and $721 million leave respectively. Conversely, the Spider S&P 500 ETF took in $2.7 billion in net new money. The Fed news sparked a banner week for taxable bond funds, as they had positive net flows of $4.7 billion. The biggest recipients of the net new money were the Core Plus bond funds and short investment-grade debt funds peer groups, which had net inflows of approximately $1.2 billion and $780 million respectively. Following suit, taxable bond ETFs also took in net new money. It was their 6th straight week of net inflows, as they grew their coffers by $2.5 billion. The largest net inflows belong to an investment-grade product, the iShares iBoxx Dollar Investment-Grade Corporate ETF, and a high-yield product, the Spider Bloomberg Barclays High Yield Bond ETF, which had net inflows of roughly $1.1 billion and $520 million respectively. The next group to take a look at is muni debt mutual funds. They continued their hot streak, as they had net inflows of $726 million. The high-yield muni debt funds and the general muni debt funds peer groups were most responsible for this, as they had increases of $262 million and $259 million respectively. The last group to take a look at now is money market funds. As stated earlier, they broke an inflow streak of 8 weeks, as they saw roughly $8 billion leave their coffers. The biggest decreases belong to the U.S. Treasury money markets and institutional money market fund peer groups, which had net outflows of $1.6 billion and $1.4 billion respectively. While on the other side of the ledger, money market instrument funds took in $1.1 billion in net new money. Well, that wraps up this week's report. If you would like to take a closer look at the data for yourself, Please go to our website at www.lipperusfundflows.com, and please join us here again next week where another one of our analysts will be speaking about that week's fund flows activity.